So the stock market is jumping off a cliff right now, but before you panic, stop. In today's video, I'm not only going to show you how to survive this. This is easy. I'm going to show you how to use this to make a lot of money. Stay tuned. This is about to get good. Now look, if you look across the board over the past week, everything is down. The Nasdaq is down 2%. The S&P 500 is down almost 5%. Tesla is down 20%, Palantir is down 22%, even the almighty Nvidia is down 14%. Everything is a total bloodbath right now. Everybody's panicking, running around like headless chickens. So, in order for me to explain to you how to survive this and how to thrive in this crisis and use it to make a lot of money, first I have to explain what the hell is going on right now, right? So what happened? Well, we had two back-to-back years in the S&P 500 in the tech sector, which were phenomenal. Yeah, we had two 30% years back-to-back on the S&P 500. That is insane. Now, companies like Palantir, like Nvidia, like Tesla, all of them flew up. Now, Palantir is a prime example. It ran 20x from $6 to $120 in just 3 years. And 2 weeks ago, I actually made a video and I told you, folks, this is a warning sign. Palantir investors beware. That was the title of the video. And I told you, right at the peak, at $115, I told you this.
I see zero issues with people selling 10%, 20%, 30% of their Palantir position just so they can say, look, if the stock collapses, I already took 30% off and I'm already covered. The stock has run up insanely. Could it drop 50, 60, 70%? Sure it can. In fact, it is probably 50-50. It might drop 50%. Palantir can be in the 60s, in the 50s, in the 40s in a couple of weeks. Easy. Maybe in a couple of months. Easy. It's a very volatile stock. It can easily drop by 50, 60% like this, like nothing. I see zero issues with people selling 10%, 20%, 30% of their Palantir position just so they can say, look, if the stock collapses, I already took 30% off and I'm already covered. So buying some insurance, getting rid of 10%, 20%, 30% is not a bad thing. It's not like I'm going to say, oh, it's blasphemous. Oh, fuck that. You can do whatever you want, right? If you're going to sleep better at night, if your mental health is going to be better, if you take a little bit off the top and you still get to enjoy the rally if it comes, why the hell not?
Now, the reason I made that video when the share price was $115 just a couple of weeks ago is because I could tell something's off. When the stock goes from 80 to 120 in just 2 weeks, something's off. A huge stock like Palantir, and I told you in that video, there is no shame in protecting your hard-earned money and taking some profits off the top. If you cannot stomach the volatility, which is inevitable with a stock like Palantir, especially in a hype cycle like this, take 10, 20, 30% off the top and enjoy yourself. And if the stock ends up collapsing, you're going to feel a hell of a lot better. Now, I hope you had a chance to watch that video. And if you haven't, might be a good time to subscribe and hit that notification bell so you don't miss it next time. Now, where do we go from here? That's a big question. Well, there's really three options. Option number one, we recover. This continues for another day, another week, and then eventually we recover and maybe in mid-March we test new highs. Very possible. Nobody knows for sure, right? If that's the case, if that's the scenario, well, nothing's changed. You just dollar cost average. Basically, we continue according to plan. But there are two other scenarios that can happen here, and both of them are quite violent. Number one, a huge crash, all the way down 30, 40, 50% crash of the entire market within a couple of weeks, and that's going to be very, very painful. And there's, of course, the scenario number three, a slow but steady decline of the market all the way to the same spot. Now, the question is, if this is indeed the case, if this is option 2 and 3, if we're basically in the beginning stages of a crash, what do we do? Well, listen to this. Number one, we understand one important principle. We understand that market crashes are quite common. For the past 100 years, the stock market crashed 20 times. That means that on average, the stock market has a crash every 5 years, not the end of the world. The other thing is, if you look that since 2000, over the past 25 years, we actually had 4 crashes, right on schedule. 25 years, 4 crashes, right on the statistic, right? In 2020, the market dropped 50%. In 2022, the market dropped 25%, 2020, the market dropped 30%, and in 2008, we had the biggest of them all, the subprime crash with almost 60% decline on the S&P 500. But here is the good news. The good news is that, number one, in those 25 years, we did have 4 violent crashes, including 2000, 2008, which were extremely violent. But in those 25 years, we have 6x'd on the S&P 500. The S&P 500 went 6x in those times. That is insane. Think about it. Since the year 2000 to the year 2025, with 4 crashes in the middle, we have 6x our money if we just set in the S&P 500. Let that sink in. Now, also think about it this way. The average bear market in America lasts about 10 months on average. That's the average bear market. Only 10 months. It feels longer because it's all relative, right? But it's rarely beyond 2 or 3 years max. It's not the same case with the bull markets. The bull markets tend to last a lot longer, 5 to 10 years, and they are a lot more violent on the way up. Now, that brings me to my next point. Keeping money out of the market because of a fear, because of a crash, usually leads to people losing a lot of money. Why? Well, that is because the stock market's best days often come in the middle of a bear market. And statistically, if you've missed the top 10 days, only 10 days, over the past 20 years, you have slashed your returns from the stock market by 50%. So listen to this. Over the past 2 decades, if you only were out of the market for 10 days, which are the best 10 days, you have slashed yourself by 50%. Now, of course, the smart asses in the comment are going to say, well, Tom, what if you missed the worst 10 days? Well, in that case, the return is going to be a lot better. Yes, it will, 100%. I'm not arguing that it won't. But here's the thing. You can make sure you're not going to miss the top 10 days because you just stay in the market, you stay invested. That way you're ensuring yourself a 100% chance of getting on those 10 days. But there is no way to get out of the market precisely on the worst 10 days. It's impossible. The stock market volatility, even for experienced traders, it's notoriously unpredictable. So even though statistically it's possible, but realistically, not going to happen. Now, I know that market crashes are painful, but they will also make a lot of millionaires. And every time we have a market crash, people make a lot of money. A lot of money. Some billionaires play a whole different game. I'm not talking about that. I'm talking about the common folk like us. We can make a lot of money during a crash. Now, you can look at a fine example in the case of Palantir. Palantir dropped all the way from $35 to $6 in 2022. Right now, even after the collapse, it is at $80 per share. That is 15 times on your money in under 3 years. Even if this thing crashes to $40 per share, which it may, people that bought at $6 are still going to be up 8 times on their money. By the way, smart people and risk appetite driven people like myself, they're going to double down on the stock when it's going to be at $40 per share. Have no mistake about it. But even if you are more risk averse investor and you don't want the extra risk, let's say you're older, you're getting closer to retirement, you have no appetite for this Palantir madness. Even if you just invest in the S&P 500, which is the most risk-averse investment ever, right? If you had $100,000 in the stock market in 2022, in January 1st of 2022, and then you rode the market all the way down because of the inflation crash, well, you ended the year at 80K, right? It's painful, it's unpleasant. You ended the next year, 2023, with back to 100K. You just made your money back. And you ended the year after that, 2024, with 125K. So all in all, if you just stayed in the market through the 2022 crash, through the bear market, whatever you want to call it, you've made 25% in 3 years, which is exactly 8 to 9%, which you make in the S&P 500 every year. It's a cheat code. Now, there is a way to increase that and make generational wealth during downturns. I call it the BML system. And this method is quite simple. All you got to do is split your portfolio in 2 parts. Part 1 will have a huge allocation to an S&P 500 or similar broad market index fund. 40 to 60% of your portfolio has to be in the broad market ETF like the S&P 500. It is a cheat code. It is undefeated. It is something that has to be the foundation of every portfolio. And if you want to make money through downturns, you also have to dollar cost average into the S&P 500 while it's heading downstairs. The more it's heading downstairs, the more you buy, because once it starts rising again, that's where the actual money-making process begins. Now, of course, a lot of risk appetite people like myself can add individual stocks on top of that, stocks that we believe will be dominant over the next 5 to 10 years, which have more upside, but also more risk, high reward stocks, right? But they also have to be Really, really good companies, not jokes, not memes, not stories, not hopes. Companies with a foundation that they actually make a lot of money over the next 5 to 10 years. Now, what is that BML system? Well, pick better, save more, stay longer. If you pick better companies, if you save more money to invest, and you stay longer in the stock market, eventually, if you give it time, you're going to make generational wealth without timing the market even once. Now look, market cycles are real, and a lot of investors kind of forget that. If you take a look at the market cycle theory, where it starts with doubt, then euphoria, then it crashes, then all over again, these market cycles repeat themselves like clockwork, and people have a goldfish memory. They tend to forget that this is repeatable. But the one thing these market cycle charts are not telling you, which is the important part, is that they're repeatable, but unlike what you see on those charts, they actually have a 45-degree slant. They are in a 45-degree angle, as long as you pick either the S&P 500 or a really, really good company. If you invested in good companies or the S&P 500, that cycle keeps going up. And the more you repeat that cycle, the higher the lowest point becomes. Now, what do I mean by that? Let me show an example because it sounds abstract, right? Look at Apple, for example, not that long ago. Apple just 7 years ago in 2018, right? So Apple in 2018 was at $57 per share, right? A lot of people said it was overvalued, and it did crash to 39 by 2019. So a year later, people saying to, let's say, YouTubers who said Apple is a great stock, oh, you're an idiot, you're a moron, the stock crashed to 39, we're unsubscribing for you, we're canceling your Patreon, whatever, right? A year later, in 2020, the stock went from 39 to 77. Everybody joins back to the Patreon, he's a genius again, etc., etc. Then, by 2020, end of 2020, we're back to 57. A lot of people disgruntled again. Then, by 2021, the stock goes to $170. Oh my God, this is the best thing since sliced bread. People pile in at the top of the hype. And then they get burned again because the stock drops to 131. They sell, they leave the market, not to come back for another 10 years. New suckers come in. And these new suckers buy and buy and buy and buy. And they buy it all the way up to 197 per share in 2023. And then the rug pull happens again. And it drops to 175. A lot of people get burned. They get annoyed. They leave. But then the smart people, they buy, and the stock is now $240. So look at this. It's very, very clear. There's 2 or 3 ways to look at this thing. You can look at it as a trader, and you can say, well, I can time these. If I study market cycles, I can tell when the uptrend, when the downtrend, I can time this, I can make money. Go right ahead. If you can do this, if you can make money, I'm not hating on you. There's more than one way to make money in the stock market. It's just not my thing. I don't like the anxiousness, the panic, and I don't want all day in front of a screen trying to guess where the bottom and the top are, right? If you can do it and you're having fun, go right ahead, not hating on you. But if you just held this long term like myself, haven't looked at your portfolio more than once a month and just did nothing, set on the stock, it went from 57 to 240 in just 7 years, which means you have 6x, you've made 500% on your money in just 7 years by doing absolutely nothing except picking a good company, picking better, saving more money, and staying longer. Pick better, save more, stay longer. BML. You'll make a lot of money. Now, let's be practical here for a second. I want to actually add some layers on top of this, right? So we have this talk about fears and market crashes and all that stuff, but in case you don't remember, we have a lot of scares that don't lead to market crashes, that are forgettable like a fart in the wind, but in the real time, it scares people out of the market. It happens a lot more often than you think, almost every year, sometimes multiple times per year. Right? These fears, they are overblown by the media for different reasons. People panic, people sell, they leave nasty comments on my YouTube videos, they leave the market, and then they come back in the next hype cycle, and they get burned again, and it kind of wax off, wax on. Wax on, wax off. Mr. Miyagi, I'm sorry. I'm sorry. Okay, but you get the point. Right. So look at it this way. In 2016, Brexit fears, no crash. 2017, hurricanes, no crash. 2018, trade wars, no crash. 2020, we had COVID, crash. In 2019, we had repo markets. I forgot about that. No crash. In 2020, mini COVID crash, but then it bounces back up again. 2021, supply chain crash. Doesn't happen. The market does phenomenal. 2022, inflation, war in Ukraine, etc., market crashes. Right? 2023, the market's going to crash again. The bank crisis, banks are collapsing, etc., nothing. 2024, the AI bubble is about to pop, nothing. Right now, 2025, the new fear is tariffs and Donald Trump. I don't know if it leads to a crash or not, but I'm here to tell you that every year, you're going to have a reason to sell out of the S&P 500, a reason to stay out of the market. But guess what? The S&P 500, since 2015 until right now, on the past 10 years, with all this garbage, all this panic, you know how much it did? It 3x'd. You've made 200% just by sitting in the S&P 500 for the past 10 years. Although all of these reasons were screaming at you, sell, 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 it's over. You've done 20% per year on average. And I know it's a complicated average. I'm just giving you a general estimate, right? About 20% per year by doing nothing, by ignoring short-term noise. And this is exactly what you do in this situation today if you want to make money in the stock market. If you want to be a degenerate gambler, go right ahead. If you want to be a headless chicken and panic, go right ahead. I don't care. I don't care if you leave the Patreon and come back to the Patreon. I don't care. But the ones who actually want to make money and have the balls and the brains to do it, listen to me. What do you do right now? Number one, you stay calm. Right? You buy the dip, and if it dips below the 20% threshold, which we talked about in the Academy multiple times, you double down. You DCA2X like a bot. Number two, you ignore the short-term noise. You ignore the panic. You focus on yourself. Number three, you stop the mentality of complaining about a discount. The only place where people freaking complain about discounts in the stock market. What the hell, folks? You want to complain about a discount for the product that's basically the same product it was yesterday and now it's at half price? And of course, you have to still also understand we're not in a crash yet. A bear market is a 20% drop. Right now, we're at 4% on the S&P 500. We're not even close yet. And that kind of drop, a 5% drop, happens 3 times per year. So right now, nothing special happened. It's just a kind of quarterly normal S&P 500 pullback. This shit happens all the time. Can we be headed to a crash? Sure, it could be, but we're not there yet. So keep 50% of your portfolio in an ETF, broad market ETF like the S&P 500. If you haven't yet, good time to start. And number two, pick great companies for the other half or 40% or 30% of your portfolio. In fact, I have a list of the top 25 stocks to invest in for the next 5 to 10 years. Obviously, Palantir's on it, Tesla's on it for sure, but there's other 23 companies on that list. It's available for my Academy members, as well as 45 recorded lectures, as well as 4 new weekly lectures every week, as well as 4 more Zoom Hangouts, Q&A sessions with me, and access to me privately every single day. All of that is in the Academy, patreon.com/Tom Nash. I urge you to check it out for your financial future. We'll teach you how to be a long-term investor, not a degenerate gambler. We don't have stock buy alerts, stock sell alerts. We'll teach you how to make money in the stock market like the rich people do, not like the idiots running around like headless chickens. I'll see you there in just a bit.